Starting a business is exciting, but many startups fail because they make financial decisions without understanding how experienced CFO think. In this video, we are sharing 15 CFO tips for new startups to understand business finance before it's too late. Number 1. Profit can lie. Many startup founders celebrate profits while quietly running out of cash. A company may look successful on paper, yet struggle to pay employees, suppliers, or rent because cash arrives much later than expenses. This hidden problem surprises many first-time entrepreneurs. A CFO never trusts profit alone. They monitor cash flow every week, compare money coming in against money going out, and prepare for future obligations. Healthy cash flow gives a startup flexibility, confidence, and stability even when unexpected business challenges suddenly appear. Number 2. Every dollar needs a job. Money sitting inside a business should never remain without purpose. Every dollar should support growth, protect operations, reduce risk, improve efficiency, or prepare the company for future opportunities instead of disappearing through unnecessary spending or poor financial habits. Professional CFO assign every available dollar to a clear objective before spending begins. This disciplined approach improves financial control, prevents emotional purchases, reduces waste, and helps startups invest limited resources where they create the highest long-term business value. Number 3. Growth can break you. Most founders believe faster growth automatically creates greater success. Surprisingly, rapid expansion often creates larger payrolls, higher inventory costs, increased operating expenses, and greater pressure on cash flow before additional revenue finally arrives to support those commitments. Experienced CFO grow businesses carefully instead of emotionally. They evaluate whether operations, staffing, financing, technology, and working capital can support expansion. Sustainable growth protects the company from financial stress, while allowing the business to scale with greater confidence. Number 4. Cash loves speed. The faster customers pay invoices, the stronger a startup becomes. Delayed collections create unnecessary financial pressure, forcing businesses to borrow money, postpone investments, or struggle with routine operating expenses despite recording healthy sales numbers every month. A CFO constantly improves collection speed through clear payment terms, faster invoicing, digital payment options, customer reminders, and regular follow-up. Small improvements in payment timing often produce significant improvements in cash flow without increasing overall sales volume. Number 5. Budget before confidence. Optimism is valuable for entrepreneurs, but confidence alone cannot replace financial planning. Many startups overspend because founders expect future sales to arrive exactly as predicted. Markets rarely behave as expected, making careful budgeting an essential business survival tool. CFO prepare realistic budgets using conservative assumptions and multiple financial scenarios. They continuously compare actual performance against planned results, identify unexpected changes early, and adjust spending before small financial problems become large operational challenges that threaten business stability. Number 6. Debt has two faces. Borrowing money is not always dangerous, but using debt without a clear repayment strategy can quickly create financial pressure. Many startups borrow to solve short-term problems without calculating future cash obligations, interest costs, or the effect on business flexibility. A CFO treats debt like a strategic tool instead of free money. Every loan must support measurable business growth, improve profitability, or strengthen operations. Responsible borrowing creates opportunities, while unnecessary debt quietly reduces future financial freedom and increases business risk. Number 7. Small leaks sink giants. Startups often focus on large expenses while ignoring dozens of small recurring costs. Unused software subscriptions, unnecessary services, inefficient processes, and frequent minor purchases slowly reduce profitability without attracting much attention from busy business owners. A CFO regularly reviews every business expense, regardless of size. Eliminating small financial leaks improves profit margins, strengthens cash reserves, and creates more resources for hiring, marketing, product development, and future business expansion without increasing overall revenue. Number 8. Numbers tell stories. Financial reports are more than accounting documents. Every number reflects customer behavior, pricing decisions, operating efficiency, spending habits, and business performance. Founders who ignore financial reports often miss valuable opportunities hidden inside everyday business activities. CFOs study trends instead of isolated numbers. They compare results across weeks, months, and years to identify patterns before problems become obvious. Better financial decisions come from understanding what the numbers are actually communicating about the business. Number 9. Margin beats volume. Higher sales do not always create higher profits. A startup can double revenue while earning less money if pricing, production costs, discounts, or operating expenses increase faster than sales. Revenue without healthy margins creates dangerous financial illusions. A CFO focuses on improving profitability instead of chasing sales alone. Better pricing strategies, cost control, operational efficiency, and product selection often generate stronger financial results than simply increasing the number of customers or transactions every month. Number 10. Build before emergency. Many businesses think about emergency planning only after facing financial difficulties. By that time, options become limited, stress increases, and decisions are often rushed. Strong companies prepare long before unexpected events interrupt normal business operations. A CFO builds financial resilience through cash reserves, contingency planning, diversified revenue sources, and regular risk assessments. Preparation provides confidence during uncertainty and allows startups to continue operating while competitors struggle to recover from unexpected financial setbacks. Number 11. Forecast tomorrow, today. Many startups only look at today's bank balance when making decisions. While knowing current cash is important, successful businesses survive by predicting future financial conditions before they become reality. Looking ahead gives founders more options and fewer unpleasant surprises. A CFO prepares rolling financial forecasts that estimate future revenue, expenses, cash flow, and funding needs. Regular forecasting helps business owners recognize upcoming challenges early, adjust their plans confidently, and make proactive decisions instead of reacting under pressure. Number 12. Customers are investments. Not every customer creates the same financial value. Some buy repeatedly, pay invoices quickly, recommend the business, and generate strong profits. Others require constant support, demand discounts, and consume valuable resources without contributing meaningful long-term business growth. A CFO measures customer profitability instead of customer count. Understanding which customers create the greatest value helps startups improve marketing, pricing, customer service, and resource allocation while building a healthier, more profitable business with sustainable long-term growth. Number 13. Systems beat heroes. Many startups depend heavily on hardworking founders who personally handle every important decision. Although this may work initially, the business eventually slows because growth becomes limited by one person's available time, energy, and decision-making capacity. A CFO builds repeatable financial systems instead of relying on individual effort. Standard procedures, automated reporting, documented workflows, and clear responsibilities improve efficiency, reduce costly mistakes, and allow the business to grow consistently without constant founder involvement. Number 14. Measure before moving. Excitement often encourages founders to launch new products, hire employees, or expand into new markets without carefully measuring financial impact. Fast decisions may feel productive, but unsupported assumptions frequently create expensive mistakes that could have been avoided. A CFO relies on measurable evidence before committing company resources. Key performance indicators, financial ratios, break-even analysis, and investment evaluations reduce uncertainty, improve decision quality, and help startups invest confidently where long-term returns are most likely. Number 15. Think like an owner. The best financial decisions come from thinking beyond today's profits. Every expense, investment, pricing decision, and strategic choice should strengthen the overall value of the business rather than simply improving short-term financial results for the current month. A CFO always asks whether today's decision will make the business stronger next year and beyond. Founders who consistently think like long-term owners build companies with stronger cash flow, higher profitability, greater resilience, and lasting business value that continues growing over time. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.